Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest is Scott Hazlett, and Scott is a California attorney and CPA who practices in the areas of taxation, real estate planning, financial problem resolution, and 1031 exchanges. He's a certified specialist in taxation law, California State Bar Board of Legal Specialization, and he also is a qualified intermediary for tax-deferred exchanges. Scott previously worked with Price Waterhouse and has been a CPA for over 30 years. And he's been an attorney for, I guess, 20 years?
20 years, yes.
Oh my gosh. Scott graduated from the University of Michigan with a degree from its business school and from Taft University School of Law in 1996 and has his own law firm. And in a past life, Scott was a sports writer covering Major League Baseball, National Football League, and other sports. And we were just talking about the Sharks championships here. It's May 19th of 2016. So you'll know by the time you see this what was the outcome for the playoffs. Scott, thanks for joining me here today.
Thanks for having me.
Okay. Today, Scott and I are going to be talking about the sale of a principal residence. And so I want to alert you all, Scott's a California CPA and attorney. I'm a California CPA. And we want you to get your own advice with a qualified advisor. This is sort of the beginning of a conversation you should have with an advisor. But we're hoping that we're going to clear up a lot of confusion in the area of sale of residence. Because Scott, you and I know that, we get our tax advice from the mechanic and from the hairdresser, isn't that right?
Yeah, well,
and the girls at the bridge club, isn't that right?
Exactly. Exactly. Exactly.
Okay. So that's why to you and I, this first question may sound a little strange, but to some other people, it won't. If I sell a residence and replace it with another one, doesn't that defer the gain?
Yeah, that's a fabulous question. So speaking of 20 years ago, the people that ask that question typically are older than 40 because they were old enough to remember the prior law, which was allowed for a deferral scheme, basically, instead of now it's an exclusion scheme. But the answer to your question is no, buying another replacement property doesn't impact your tax outcome in any way, shape, or form. So,
when did that change?
Yeah, so the change came in, I believe it was May 6, 1997, right? And in effect, it phased in August 5th of 1997. So the rule before was that if you sold a residence and you bought a residence for at least as much of that price, that you could defer the gain. So let's say you bought a property in 1960 for 10, and you sold it in 1985 for 200, there was 190 gain. Then you bought another property in 85, and there was a rule like 2 years before, 2 years after, and you were in that 200 plus range. Then that 190 gain was avoided and deferred into the next property and next and next and next. So when the law changed in 97, there was a new philosophy. There was a concept of exclusion. So if you had what accountants call a basis compared to the price, so let's say you sold a property for 400 and the basis, what you had paid for the property originally was 250, you'd have a 150 gain. And the law allows for an exclusion of up to 250,000 from taxable gain on this sale, provided you meet all these rules that we're going to talk about. So that was a permanent exclusion. Not only was there no availability of buying a replacement property, but there was no need to buy a replacement property because this is a permanent exclusion. And I mentioned the rule about 250. That's for a single person. A married couple can enjoy a $500,000 exclusion provided they file jointly.
Right, and they have to meet some other requirements
Correct.
related to ownership and other things. So anyway, just be aware of that. Okay. So what if you acquired the house in exchange?
Well, that's an interesting question. So first, I think it's a good idea to step back and talk about what the ownership and occupancy requirements are.
Okay.
So the general rule on this is if you want to try to claim this exclusion, you have to occupy the property for 2 years of the 5-year period ending on the date of sale. So if you sold the property today, today's May 19th, 2016, you look back to May 19th, 2011, and you say, have I occupied that property for 730 days, at least 2 years, not necessarily consecutively, and not necessarily at the date of sale. This could have been 2 years ago that you had your 2-year occupancy period. So that's the occupancy requirement. And then the ownership requirement is you have to own the property for 2 years out of that 5-year period.
So one of the spouses has to own that property.
One of the spouses, if it's a joint,
Yeah.
but both spouses have
to live in it.
have
Yeah.
to occupy. And then you get into the question about what happens if we're living in sin. Well, that qualifies, even though you're bad boy and bad girl, but living in sin can count towards this rule. So now comes the question, what happens if I try to use this rule on what we call a former 1031 property? So let's say I had an office building and I sold it and I bought a house. And I bought a house on, let's say, 1/1/13. So that's not quite 3 years ago, or it's a little more than 3 years ago. And so the first thing that happened with that property, in order to get the 1031 benefits, I had to rent it for some period of time. So let's just say, for the sake of discussion, I rented it for a year. So now we're at 1/1/14, and I live in it after that date, 1/1/14 to present, and I sell it today. Under the 2-year rule, I have occupied it for 2 years, within the 5. I've owned it certainly for 2 years within the 5 years. However, there's a rule called 121D10 that says that a former 1031 property has to be owned for 5 years. So in that fact pattern, you do not get the exclusion in those facts.
Right. Okay. So it has to have been used as a principal residence, I guess, during that 5 of the last 10 years. So anyway, yeah, it's a lot tougher now, and that just kicked in a few years ago.
That
too,
came
right?
in 2004.
Yeah. Okay.
A few years ago.
Yeah. Well.
Yeah, just
12 years.
Just a few years ago.
Well, we consider 1997. But
Yes, correct.
Okay. Okay. Well, what happens if the house is used for a non-residential purpose or for rental?
So are you talking about partial occupancy?
Yeah, the partial exclusion
roommate
and all
the
the
roommate?
others.
Okay. Well, the roommate situation or the office and residence.
Well,
is
no, actually, no. What I'm talking about is the situation that, conversion or, where they said now you don't necessarily get the whole gain excluded because.
Oh, okay, okay.
Because you're using it for a non-resident.
So there's a rule for all you tax junkies out there. There's a rule called 121B5. B as in Baker 5. And
He's a code head.
I'm a code junkie. There's no question. That's the only way I keep track. Okay. So 121B5 says that there's a limitation or a reduction of the benefit. So go back to that 250 exclusion and so forth and so on. So, and this doesn't really play well without a flow chart and a whiteboard.
Unfortunately.
So here's the takeaway, and I'll just illustrate an example. So, client calls me up and they say, I got my investment duplex in San Jose, but I want to move to San Mateo. So I want to sell my duplex, and I want to buy a house in San Mateo on a 1031 exchange, and that works out just perfectly. So they rent the property for a couple of years, and then they move into the property for 2 years. So now they've had a total ownership period of 4 years for that property. And their theory, when they're explaining this to me, so we'll rent it for 2 years, which is great, qualifies for the exchange. Then we'll move into it, which is permissible, and that becomes our home. And then we want to sell it at the end of that 2 years because then we qualify. Well, first thing I'd say, you have to live in it really, you have to own it for 5 years. So that's your first mistake. So then they say, okay, we can live there, we'll live there 3 years. So now they've met the first test that you just talked about, the D10. So now they say, well, then we want to exclude the gain because the gain's going to be about 500. We're married, filing jointly, we live there, we both live there. Well, this B5 rule, this 121B5 rule says there's a fraction which looks at the time involved. So the fraction is the numerator is a number of days or years or periods, however you want to express it, of what's called non-qualified use. And the non-qualified use in this case is 40%. It's the first 2 years. The denominator in this fraction is all of the period of ownership after, or all the ownership period of the property. So that's 5 years. So that's where you get the 40%, 2 divided by 5. So they have, let's say they have a $300,000 gain, and they got this 40% thing that we've just worked out. 40% of that 300,000 is not eligible for the gain exclusion. So they have to pay tax on 120,000. So their plan in effect falls on its face. Mm-hmm. The way to avoid the problem is, of course, live there for 17 years and make the fraction so small that it doesn't matter. But you have to live there a long time.
Uh-huh.
Okay?
Yeah. Okay. Now, what if I move? I'll throw out that I moved from Chico to San Jose.
Okay.
And so I've got this house in Chico, but the market's not as good in Chico as it is in San Jose. It's crazy hot here right now.
Right.
And so I move out, but it takes me a year to sell the place. But I bought another home in San Jose. So now what? Now I sell the house in Chico. Do I have to count that period as non-qualifying use?
Right. So that's an exception to that non-qualifying use. So the non-qualifying use is only, it consists of one of two things. It basically consists of anything other than principal home, but it's typically a vacation use, like a second home, or investment property. But that's only the time before the last time that you live there. So any time you move out of a property, and in effect for the next 3 years, if you don't have it, even if you rent it, that's not considered non-qualified use. It's really an exception to an exception that just drives us insane. But effectively, that doesn't hurt you. It doesn't hurt you because now remember, if you lived in it for say 10 years or something, then you move out, and if you don't sell it within 3 years of moving out, you're outside of the window anyway.
Yeah, you don't qualify.
You don't qualify anyway. So they encourage you to get rid of it, but as a carrot, this 3-year plan doesn't affect you, doesn't hurt you.
Right. So then that's not a period of non-qualifying use after you move out.
Correct.
With the idea that eventually you can probably sell the place or whatever. But you could do something like rent it in the interim, and it still wouldn't hurt you.
Correct.
All right. What about accumulated depreciation? Again, we talked about the situation of conversion.
Yeah. So let's say that you rented a property a long time ago, and then you finally moved into it, and over this early period of even 2000 to 2005, you rented it, and you developed accumulated depreciation in the rental activity years of say 50,000. So then you own it and you live in it, and you meet this gain exclusion, the 121, the standard rule. You get the 500,000 exclusion. The depreciation is recaptured, but it is not eligible for the exclusion rule. And just to keep in with the theme, that's 121D6, but who's counting? Right?
Okay, so it doesn't qualify. And it's also taxed at a higher
doesn't
rate,
hurt
right?
it doesn't hurt the real. So if you have an economic gain, you bought a house for $1 million and you sell it for $1.5 million, that's the gain that this attaches to. But the depreciation recapture comes back as income no matter what.
Right, and it's taxed at a different rate, isn't
That's
it? Right?
correct. That's correct.
Okay, well, what if you have to sell the house before meeting those ownership and use requirements because of unforeseen circumstances?
Right, so there's three, the general rule is this 2 out of 5 year concept. The law does allow you to take a partial use of the exclusion for circumstances when you sell. If you sell for health reasons, for a job change, or for what are characterized as unforeseen circumstances described in the regulations. Not the ones you make up, the ones described in the regulations. So, they say unexpected pregnancy, and there's a few other things. But basically something you can't control, it's unforeseen. So I'll give you an example. So I buy a house in Menlo Park, and of course the prices are just going straight up into the sky. And I'm with one of the big tech companies, and I lived there for a year, and I've enjoyed a lot of appreciation. And then they say, now you're moving to Austin to our headquarters there, or our plant there. Then you say, well, I can't really afford to keep 2 houses. So I sell the Menlo Park place. But I've got this big gain. I got a $100,000 gain, and I'm going to get clobbered. So if a single person, normally they get $250 if you make the 2 years. But if they just move to Austin and keep the property and wait till the 2 years is over, it's not a residence as occupied, so they can't qualify that way. So they elect to sell. So they live there for a year, they own it for a year out of the 2, they get to take half. So the exclusion is $125,000 for a single person, so therefore it covers that $100,000 gain that I used as my example.
Yeah. It's not as good of a deal as it used to be here
No.
in Silicon Valley. I mean,
No, correct. Correct.
we're seeing properties that are going from,
Yeah.
$1 million to $1.5 million.
Well, this is but I always remind the clients, I would love to pay $1 million in tax. That would be a high class problem, given the tax rates are. Yeah, I know.
The problem is that you still have to buy the other place.
Yeah.
Okay. Are there any special considerations when you bought a residence before August 6th of 1997?
Oh yeah, that's a great question. So client, and of course as we go later in time, this is less and less a problem.
Of course, yeah. They're all dying off, right?
But it dovetails into the next thing that I want to mention as well about a highly appreciated, long-held property. So in this case, the basis in modern practice, effectively, if you bought a house after 1997, the purchase price plus the improvements is your basis. So you pay $100, you put a pool in for $20, your basis is $120. That's the basis on which you gain. So you sell for $320, you've got this $200 gain, and it's pretty straightforward. And that was sort of the aspiration, the rules, that it would be real easy to measure. Going back to the original example from the outset of the program, we mentioned you could buy a house in 1960, sell it in 1985, buy another one. So it's possible that the basis of your property isn't just the purchase price plus the improvements, but it's reduced for all the gains avoided in the prior transactions. So sometimes you have the discussion, you got an 80-year-old client sitting in your office and they say, I'm selling the house. Okay, what did you pay for it? Well, I bought it in 2004 and I paid $1 million and now it's worth $1.3 million. Oh, really? Okay. Or excuse me, let's go back. Let's go back a little farther.
Before that, yeah.
Let's say 1995. I bought this in '95. I paid
Right.
$300. I'm selling for $1.3 million, or something. So 300 is not the basis, because you say, well, what'd you do before then? Oh, well, I lived in Menlo Park, but before that I lived in San Mateo, and before that I lived in Union City. And before that I lived in San Francisco. And then in 1941. When I bought my first house for $10. I mean, it can literally go back a string of these rentals because that law was in effect for many, many years. So there's an investigation of basis. That was one of the reasons why they brought this rule in, because people didn't have to keep all their old paperwork.
Right.
It's kind of ironic. So now here we are.
Right. And
now,
you're supposed to have all those old tax returns, right? We all keep them.
all tax returns. Well, you got a scanner and a thumb drive and all that stuff. This is Silicon Valley.
Yeah, we had a scanner in 1997.
Yeah, right.
Sure, right, or whatever.
So let me mention another one that's actually happens somewhat frequently. And actually, this is a good point for older viewers who are in a very highly appreciated house. Let me just give you an example. So I had a client call me from Saratoga, and the house is worth, like 90 million or something. Just some
Astronomical number.
It was a big number. And they say, well, I can't really keep the place up, and I want to sell it. And they said, well, how old are you? Well, I'm 80. Are you going to die soon? Dying is really great because basis steps up.
Right.
No, I'm never going to die, and I'm
right.
really healthy. Okay, that's fine. So they want to sell. They do want to sell. So what'd you pay for the house? Well, we bought the house in 1959 for about 70 grand, and our gain is $3 million. Well, if they sell, they get 500 free, and the rest is taxable. That's no fun, and there's nothing you can do. However, if they move out of the house and convert it to a rental property for some length of time, ideally 2 years, but not necessarily, and that depends on your advisor. They rent the house out, they sell the property, they intentionally scrape aside $500,000 of cash boot, what we call in a 1031 exchange. That's taxable gain, but they've got this exclusion rule, which is still in play, even though they didn't live in it at the end. They take the excess of the money and they buy an investment property in replacement. So they've used both of these rules to avoid immediate taxation on the gain that they otherwise would have paid.
Yeah. So I can't tell you the number of times I've had very senior clients where either they or their families were determined to sell the home, and I couldn't, let's just say they wanted the cash.
Yes.
That's what it boiled down to.
Right.
And there was no talking to I said, because I had one of these where I think let's just say within a year, there was a husband and wife situation. Husband had gone into a care center, and the wife said, "I just can't deal with having." I said, "Well, why don't you get a property manager? You can rent the place out or whatever."
Right.
No, you can't do that.
Right,
and
right.
so,
They got clobbered.
so she sold it. She made her donation to the federal and state government.
Yes.
And and husband passes away, and it's a shame, free stuff up there. I mean,
could have been avoided.
Could have been nothing.
That's correct.
Yeah. Well, what is a principal residence?
So the regulations provide it's your principal abode, and there's a whole bunch of definitions. It's a facts and circumstances case. The address on page 1 of Form 1040. Where do you get your mail? Where do you go to church? Where do you typically spend your time? There's an interesting audit test that I've noticed in the past where the IRS will actually take your credit card slips and your statements, and they'll see where you incur a good deal of your charges. And so if you're at the Safeway in San Jose buying your groceries every week, and you say, no, I live in Grass Valley. No, you don't. You live in San Jose because you buy your gasoline at the gas station down the corner, that kind of thing. So those are the types of indications of what your principal residence is.
I think a real critical one is just where do you work?
Correct.
The guy says,
where do you bank? Where do you work?
Yeah.
Just what does it look
the
like?
guy says, I got a principal residence in Chicago, but he's working in San Jose.
Correct.
That's going to be a problem. Now, his family may be staying in Chicago.
Right.
And so there may be some arguments going back and forth, but it's a pretty hard one to fight.
Correct. That's correct.
And there are special rules for pilots and other.
Well, then you got travel and am I out of town? Am I not out of town? And what's the rules? It's a lot of different things.
Okay. I had stuff about short sales and other stuff, but I don't think we really need to worry about that very much anymore.
No, isn't that nice? I mean, I spent the better part of 6 years consulting with clients who come in, and the first paragraph was always, "My house is worth $100, my loan is $700." What do I do? And I say punt.
Yeah, things have changed.
Yeah, no, it's pretty nice.
I'm kind of glad about that.
Yeah.
Just to not have to deal with those problems.
That's a lot easier.
Maybe you have some final thoughts to throw out related to principal residence.
The main thing I think is just get advice early. The worst thing that I hear about, whether it's 1031 exchanges or 121, this home sale rule, people call up and say, I'd like to have an appointment because I'm in escrow to sell. And if you just had that conversation 2 days earlier, maybe they wouldn't have sold, and maybe you could have avoided this thing. The senior clients are a perfect example. What are you really doing here? Mm-hmm. And then this whole idea of shifting, going from one to the other. Still, many of these people think that you buy a property in a 1031, and you can just rock and roll, and you just have this whole thing laid out, which used to be the rule, but now you've got this non-qualified use, and you're going to get clobbered anyway. You have to go and crunch the numbers.
Uh-huh.
And it's just a matter of crunching the numbers and looking at what is going to happen. If you sell today, what happens? If you do this, what happens? And the other thing is, frankly, a lot of situations, sometimes people should sell, and they tend to let the tax influence other parts of their life. Like, okay, well, if I move 3 times in the next 6 years, I mean, people, for example, they'll build a residence, and then they'll live there, and then they'll sell it, and then they'll build and they'll sell, and they'll build and they'll sell. It's like, okay, well, you're making tax-free income. There's no question about that. But at what stress on your life? You know, do you get kids? Do they have to change schools? You know, these types of things.
Well, there's a couple of other things to think about. So one is basically property tax issue.
Prop 13.
So the idea that, you know, I mean, you're living in a residence that is worth $1 million, and now you're going to go and you're going to buy a home, and maybe it's 750 or 800,000. You're thinking, okay, I'm moving down.
Right.
But you've been in that house since, you know, 1960.
Yeah.
And so you're paying property taxes of $1,500 or a couple thousand a year,
Right.
and suddenly you're going to go and you're going to move into a place and your property tax bill is going to be $9,000 a year.
Exactly.
So have you really gained ground,
Yeah, exactly.
you know, by doing this?
Yeah.
And another thing is, I think, just keeping good records. And a lot of people are very careless
Right.
for when they make improvements to their home.
Yeah.
And frankly, a lot of contractors aren't very good about providing very good paperwork either.
That's correct.
But to establish what is your investment in this place, and again, here in Silicon Valley, you may have a gain in excess of $1 million. You know, suddenly those records are really important that you could have really avoided quite a bit of tax.
Every scrap of paper is worth 10 grand. You know.
There you go.
Yeah.
Okay, folks, we're out of time. I have a book, the Real Estate Tax Handbook. It's available on Amazon.com. There's a chapter in there about sale of residence. There's also an IRS publication on sale of residence that I recommend that you consult when you're dealing with this, and see a good tax advisor. Scott, thanks for joining me. It's been a pleasure having you.
Thanks.
See you next time on Financial Insider Weekly.